Hey everyone, I'm Roger Herring and welcome to this week's version of Ask Roger. This is the time you get to ask me a real estate related question. If you want your question answered on the air, shoot a message to info@investorsaccounting.com. You can inbox me on Facebook or just put a comment on this video. If we choose your question, we'll let you know. Let's get to it. This week, Davis in Macon, Georgia writes to me. He says, my wife and I are real estate brokers. We also do a few fix and flips each year. But to me, it feels like we're giving back almost everything we're making to Uncle Sam. What can we do? Your feeling may not be too far off. You see, the problem, Davis, is you've got a whole bunch of ordinary income, and it's the most taxed income. You know, it doesn't surprise me because I get it all the time. Investors will get out there and they will flip properties, they'll wholesale properties, but they won't take advantage of the real estate tax breaks. Those are found in rental properties. We'll get to that. The first thing you should do, though, is make sure you are minimizing your ordinary income tax burden. What you need to look at is how much is your adjusted gross income, and make sure you are in the right business structure for your level of income. First off, if it's under $315,000 and you are married, as you are, married filing jointly, then you should be looking at an S corporation or what we call a spousal partnership, where one spouse is the general partner, the other spouse is a limited partner. If it's over $315,000 adjusted gross income, then we start looking at SCorp strategies. So first thing to do is make sure you're structured right so you're not giving Uncle Sam any more than he's entitled to. The second thing we do is you go out there and you buy some rental properties. And you don't just buy one or two, you buy several, because here's the thing. You're already a real estate professional. All right, that means you spend at least 750 hours in real estate as an owner, and more than half of your for-profit time is in real estate, again, as an owner. Because you're already there as a broker, guess what? Your deductibility of rental losses is unlimited. And those losses, they're not real. We create them. They're what we call phantom loss. The other thing that you're going to do, you're going to use leverage. You're going to get out there and you're going to build a large portfolio. And for each property that you acquire, we're going to use specific depreciation tactics, and we're going to do what we call front loading. Front loading means that we're going to segregate your costs and break out 3, 5, 7, and 15-year items away from the entire structure of the house, so we don't have to depreciate the whole thing over 27 and a half years. At the end of the day, it's a whole lot of tax savings. And let me tell you, I've used this strategy for a long time, over 18 years in fact, and I've got clients that haven't paid anywhere near what they normally would in income tax for years. All right, these things that we talked about today, we're going to be going over this stuff in detail on June 14th. I hope you can join us. We'll be at the 1818 Club, and hey, the cost of this seminar, it's only $50, and that includes the 1818 Club's awesome breakfast buffet. I hope to see you there. There is a link to the Eventbrite page where you can sign up. Until then, Roger out.